Warren Buffett's mentor, the legendary investor Benjamin Graham, outperformed the S&P 500 index by a wide margin over a 20-year period. He also wrote two books that are still considered as the most important books on investing ever written. They're all about value investing, so it might come as a surprise that Graham actually achieved his remarkable performance primarily by not following his own investment advice. Now, if you think I'm kidding, please stay tuned, and you'll see that what I said is quite literally true. Also, at the end of this video, I'll make an announcement regarding my Trend Compass reports that you might appreciate. Hello, and thank you for joining me once more at the Markets, Trends and Profits channel. Today's video is the long overdue follow-up to the last month's report, in which I made the case that market trends are far and away the most powerful drivers of investment performance, and in which I discussed the merits of momentum investing. Recall, momentum strategy is a variant of trend following, as it involves systematically picking top performing stocks and holding them for as long as they outperform. An empirical study covering more than a century of stock market data showed that this strategy massively outperformed the stock market indices in 17 out of the largest 18 global stock markets. I concluded the video by conceding that trend following and momentum strategy may be counterintuitive for many investors because it involves buying assets only after their prices have strongly appreciated and selling them well past their peak. By contrast, value investing seems much more appealing since it involves shopping for investment bargains and buying assets at low prices. Furthermore, value investing has been championed by two of the most successful investors ever, Benjamin Graham and Warren Buffett. But as I mentioned in that previous video, the truth is that both Graham and Buffett owe their success entirely to momentum investments rather than value picks, and this is what we'll discuss in this video. Benjamin Graham wrote Security Analysis and The Intelligent Investor, and both of these books are widely considered as the most important text on investing ever written. Graham generated an extraordinary annualized return of about 20% over a 20-year period from 1946 to 1966. During this time, the stock market overall returned about 12% per year. Warren Buffett himself generated a compound annual return of about 18% during a 30 years interval through 2005 when I conducted this analysis. Over the same time, the S&P 500 index returned about 10.8%. While Graham and Buffett are generally regarded as value investors, their success had more to do with market trends than with superior value-finding skills. In The Intelligent Investor, Graham observes powerful market trends as they confound his value judgment on stocks. In 1953, as the US stock market enjoyed one of its longest-running bull markets until that time, he cautioned investors that the stock prices were getting too high. As it turned out, he later wrote, this was not a particularly brilliant counsel. A good prophet would have foreseen that the market level was due to advance an additional 100% in the next 5 years. By 1959, the Dow Jones reached an all-time high at 58.4, and again Graham warned investors that stock prices were far too high. Regardless, the Dow continued to rise, reaching 73.5 by late 1961, and after a 27% correction in 1962, it soared further to 89 in 1964. So Graham thought that stocks were overpriced in 1953 as they were about to treble in value over the next 11 years. Selling your investments before a 200+% bull market isn't a good way to earn great investment returns. So how did Graham generate the remarkable results from his investments? As I suggested at this video's opening, the answer is that he did so by not following his own investment advice. Instead, Graham inadvertently did what a trend follower or a momentum investor might have advised him to do. He held on to his best performing investment even though it was overpriced from the get-go. Namely, in 1948, he and his partner Jerome Newman purchased a 50% interest in the Government Employees Insurance Company, or GEICO, as it's better known today. The purchase was very considerable in size and comprised about a quarter of their fund's total assets at that time. Here is what Graham wrote about their GEICO investment in the postscript to The Intelligent Investor. It did so well that the price of its shares advanced to 200 times or more than the price paid for the half interest. The advance far outstripped the actual growth in profits, and almost from the start the quotation appeared much too high in terms of partners' own investment standards. Graham explains why he and Newman did not sell GEICO even though they judged its price much too high. Because of the size of their commitment and involvement in the firm, they regarded it as a sort of family business and maintained ownership in it in spite of its spectacular price appreciation. In Graham's own words, The profits from this investment far exceeded the sum of all the others realized through the 20 years of wide-ranging operations in the partner's specialized fields involving much investigation, endless pondering, and countless individual decisions. In other words, far more than one half of Graham and Newman's investment performance came from the one investment they kept through a 2 decades bull market, even though it was grossly overpriced by their own investment standards. That implies that all their investigation and endless pondering contributed less than 10% in annual returns, underperforming the stock market by at least 2 percentage points over 20 years. So if Graham and Newman had only invested in Geico and spent the rest of their careers fishing and golfing rather than burdening themselves with investigations and endless ponderings, they would have done at least twice as well as they have done, generating annual returns of 40% or more from 1948 to 1966. For his part, Warren Buffett's style reveals much more of a momentum player than value picker. He made many of his large investments on the back of major run-ups in stock prices. Examples of this include his investments in Capital City, Salomon Inc., Coca-Cola, Gillette, Freddie Mac, General Dynamics, Gannett Company, and ConocoPhillips. For example, Buffett bought over $1 billion worth of Coca-Cola shares after they had already appreciated more than 5-fold over the previous 6 years and more than 500-fold in the previous 60 years. This decision proved right, however, as his investment in Coca-Cola quadrupled in value over the following 3 years, far outstripping the stock indices like the Dow Jones and the S&P 500. In 2007, Buffett started buying stock shares of the oil company ConocoPhillips. At first, he bought about $1 billion worth of the company, paying an average price of just under $60. That wasn't a value pick. Over the previous 5 years, the company's share price had increased by almost 5 times, from $13 to $60. But even as the share price continued to surge, Buffett kept buying. In the end, ConocoPhillips became the largest single investment he had made up until that time. He invested fully $7 billion in ConocoPhillips at an average price of over $85 per share, making up almost 15% of Berkshire's portfolio. Unfortunately for Buffett, the oil price sustained a spectacular collapse in 2008, dropping by over $100 per barrel from nearly $150 to under $40 per barrel. But even so, his actions there revealed a momentum player, not a value picker. And just like Graham before him, Buffett also owed much of his success to Geico. He started buying its stock in 1975 at $2 per share and kept adding to this investment even as the company's market cap went from $296 million in 1980 to $4.6 billion in 1996, corresponding to a compound annual rate of return of 29.2%, outpacing the S&P 500 by over 20% per year. Did this prompt Warren Buffett to sell his overvalued company? To the contrary, in 1996 he bought the remaining 50% of Geico, making Berkshire Hathaway 100% owner of the company. This was not exactly a value pick either, but that decision too proved a winner. By 2011, Geico's market cap nearly quadrupled to $20.5 billion. Even though Graham and Buffett somehow came to epitomize the so-called value-driven investing, they both owed their success to momentum plays, without which both investing legends would have underperformed the market benchmarks. In essence, Graham and Buffett may both have overtly espoused value investing because it's a rational style and as such it is much more attractive to investors. However, they both achieved all of their outperformance not from superior value picks, but from momentum plays and price trends. Now, if this video ambushed you a bit with the subject of momentum investing, I'd like to encourage you to also see my previous video MTP 006, where I elaborated on the strategy in more detail, summarizing over a century worth of empirical data from world's largest 18 stock exchanges. I will include the link to that video in the description below. You'll find all the sources and references for the claims I presented here in my book Mastering Uncertainty in Commodities Trading, which won the award as the #1 book on commodities trading by financialexpert.co.uk. Finally, about the announcement I promised at the beginning of this video. As some of you know, I publish the iSystem Trend Compass reports, which provide daily trend following signals for over 200 financial and commodities markets. Trend following works because markets move in trends, and trends are far and away the most powerful drivers of investment performance. Trend Compass reports are based on the iSystem technology, which analyzes a wide variety of markets for early signs of emerging trends and generates trading signals so you can navigate the markets confidently, profitably, and with peace of mind, both during bull and bear markets. While the reports are priced for professional users, I've also resolved to create a number of affordable reports for retail investors, and I've now added 2 such reports to our list of products. The USA portfolio, which covers the 4 major American stock market indices and the 10-year and 30-year Treasury notes, and the USA Plus portfolio, which covers all these markets and also gold, silver, and Bitcoin, with 10 intelligent trend following strategies per each market, covering long, medium, and short-term trends. The list price for these reports is 200 and 250 euros per month, but, and this is the special part of this announcement, I'll make them available at half the rate for the first 100 subscribers, who'll also receive a free copy of my book. Do not hesitate to sign up. The first month is always free of charge. If you subsequently decide that this is not for you, there's no further risk or engagement on your part. To subscribe, please send me an email. The address is trendcompass@isystem-tf.com, or visit the Trend Compass page on our website. Thank you for joining me today. If you appreciated the content of this video, please give it a thumbs up and consider subscribing to the channel so that you don't miss out on further quality discussions about the markets, investing, and trend following. Until then, keep well, stay free, and I'll see you soon.